Hello everybody, welcome back to another Lumley trading stream. Sorry it's a few minutes late, I'm just coming back from my other house and only just got in. Anyway, we will be running through everything. Do have some work going on at the house, so I'll probably be leaving on Bloomberg most of the time. This will probably be for tomorrow as well, but after all that, we should be all good. So as we're running through things, obviously I'll chime in, but otherwise we'll just leave Bloomberg to speak.
First one with the heat wave out in the Midwest. You are truly expert. Guys, like a Brooks and Dunn song where they talk about the Midwest. They don't know nothing down in Nashville. Gartman knows it. How does red wheat look right now with the heat out in the Midwest?
Again, actually, there's a few things we'll go over because there was some key news coming out. So let me quickly just grab those and then we'll carry on. But again, key watches today are going to be Meta. Obviously, Meta did release their threads today, kind of a Twitter competitor. As of right now, I think that was kind of the key thing that was happening today. Definitely a lot of things. I think I've already seen 7 million shares. 7 million people sign up to it. They did gap up today. They've already given up that gain though. I'm just running through, seeing if I can see any key things about Meta, but I can't see it on here. If not, I think it was through an email, so we'll run through that in a second. Let me just find all the information. In the meantime, I'll leave Bloomberg on.
I mean, Paul, when Gartman was doing 36 holes a day and write the newsletter at 3 a.m., I'd have to bone up on things.
Sure.
So one day I read like 88 pages from Goldman Sachs on getting from cattle to chicken. Ben Laidler wrote about this at eToro today. Dennis, help us here with the price of beef goes up, so live cattle goes up like a moonshot, so they grow less cows, which rolls over to pork, where pork goes up but not as much, and then they cut the pork price, and everybody ends up eating chicken. Explain that process, Dennis.
It's a process of substitution, no question about it. When cattle prices go as high as they've been, people will substitute cattle for chicken for cattle. Chickens are easier to grow, faster to respond to the demand cycle, and use less soybean meal than does cattle. So it's a process of substitution. It's characteristic. It's happened for decades. It'll happen for decades in the future. But it's precisely what's going on right now. No question about it.
It's amazing. It was a brilliant essay by Ben Laidler. Down negative 300.
I read that one. It was very good.
Yeah.
Dennis, how is the American farmer doing today?
Depends on where he's at. I mean, it really depends on where he's at.
Here we go. Already found the thing on it. So I'll throw it on the screen real quick. So we do have 10 million now users signed up for the app in the first 7 hours after launch. So already quite a big thing. And as well, this is coming after Twitter has kind of restricted one of their biggest selling points, which was, especially from like us when we're looking for trading news, that used to be quite easy using Twitter. You had TweetDeck, you also had APIs that would send the news from Twitter to Discords. A lot of this is being removed, and one of the big selling points, obviously they brought in the limitation of how many tweets you can see as well. So that's one of the big changes and may make threads kind of stand out. They kind of launched this at a good time, so this will be key. But the key thing is about how many users are signing up so quickly. Because ChatGPT was one of the quickest growing ones, and don't forget that I don't think they even did 10 million in 7 hours. I mean, that's a crazy number. So that's one of the key things standing out. We'll run through some other things as well. So quick recap then for the FOMC. Again, we were live during all of that. We were talking though, the Federal Reserve minutes showed its June decision was a pretty hawkish move. There was disagreement among officials to whether the rate should stay unchanged or increase by a quarter point instead. It was a little surprising though that when we heard about this originally, it was told as a unanimous decision from the Fed. However, it came out yesterday that there was actually a divergence between the opinions, and almost all did agree though that we should be seeing more tightening this year. We also have Yellen, so the US Treasury Secretary, has arrived in China, is aiming to find common ground to open up communication channels. It's the first test of her policies revealed in April that geared to defending US national security while not holding China back. Her visit also comes after controls between the two countries were ramped up, as China curbs some metal exports while the US considers restricting access to cloud computing. We also got the Threads debut, so kind of what we were talking about just before. Anticipated Twitter rival, Threads have officially unveiled by Meta Platforms Instagram, launching the most serious threat to Elon Musk's social media platform Twitter. The app has already had 10 million sign up in its first 7 hours, still way off of Twitter's 300 million users. But overall, Zuckerberg tweeted for the first time in 11 years, taking a playful swipe at Elon. I think that's going to be the key stuff then from the overnight news and things we want to be paying attention to. Obviously, we'll quickly run through the economic calendar. We had the non-farms, or not the on-farms, actually. We had, the initial jobless claims come out pre-market today at 8:30 market time. They were forecasted at 245,000, came out at 248,000, so pretty in line. And that's why you didn't see a massive move off that release. Then coming out in 17 minutes, so 10 o'clock, we have the ISM PMI, or ISM Manufacturing PMI, the ISM Services PMI, and we also have the JOLTS job opening. So the main focus on this is going to be the JOLTS job openings and the ISM Services PMI for today. And just quickly go on what's in line. So the ISM Services, we're forecasted a 51.3. Again, this will be quite key when watching this. Whenever we're close to 50, this is good. We tend to get a big move if it goes against the consensus. So right now we're above the 50 consensus. So if we come in below 50, you'll probably see a relatively big move. If it comes in line over the 50, the move will most likely be a fade, something we can look to kind of just play against the release. And then also we have job openings, so the JOLTS, coming in at a forecasted 9.93 million. So again, we can kind of see this, but this is normally a fade as well. The main focus goes on to the non-farms on the Friday. So again, we'll cut back to the Bloomberg now. If you've got any questions, obviously let me know, but otherwise we'll let the Bloomberg play out.
Those stories all the time where it's out there in heat like this, and then one of the players collapses or something like that.
I'm not amused. They need to get a life.
And they've cut that back too as well. But I mean, the facility out for the Jets out in Jersey, out in Florham Park, that's awesome.
That's the Aaron Rodgers Memorial
That's
Park.
right. Exactly. Exactly. They have an awesome facility out there. So that'll be. I bet you the press is going to be all around that for the Aaron Rodgers show. They're on national TV, I believe.
As well, MU coming into lows, we do have a level quite close. We'll quickly plot it on the chart and zoom out so you can see it, but we are coming in close into a strong support on MU. Could potentially look for either a long as a day trade or a swing trade, but definitely something I'm looking at long bias.
Tomorrow's economic data all of a sudden is really critical to see if it confirms the job surge of the ADP report. The 2-year yield up 10 basis points through 5%, 5.04%. West Texas, $71 the barrel. Paul Sweeney and Tom Keene, stay with us. From New York, this is Bloomberg.
You already know that the TuneIn app lets you listen on the go.
Just noticed as well, we have actually already hit into the level from the 6 month. We're at $61.15. So again, we kind of opened below it, retested it. Let me quickly get the zoom tool open. Yeah, so we opened up, kind of broke back through above that level, but now testing these lows. So again, could be looking for that downside potential as of right now. If we do break this, though, again, we could be looking for a potential swing long. Our target, we're looking for probably only about 2 points. Actually, probably not a swing because our closest statistical mean out of the two is at $63. However, if we can fall lower, we would then be looking at a support at $58 will be the next level I'm paying attention to. So that I'll be paying attention to if we can break lower. So again, just to show you from a chart perspective, we'll put the resistance as well, or the kind of high target. That is what I'm paying attention to on MU. If we're buying this level in anticipation of a hold, we're looking to play to 63. Obviously, we have an intraday resistance of 62.43. If we end up cracking down, the next potential long is going to be around that $58. It's actually $58.08. So yeah, that's key support and what I'd be looking at then on MU. We also have the dollar. Just so you know as well, the dollar has become weak in the pre-market. So this orange line, this is where we were coming into the FOMC release. And what you can see is this level is been holding quite nice. So FOMC drops, we sell off. That was this move here. We then got strong on the dollar. We held this coming into the close. And then coming into the morning, we did get a sell-off. We got kind of this retest area. And then we sold off quite strong. Then coming into 8:30 or kind of 8:15, you can see we did get quite a strong move. Again, this was coming into the ADP job numbers. And then from there, it's been still pretty weak. We're still struggling to break back above that key level. So paying attention to that on the dollar as well. As of right now, can't see. Actually, Tesla is at a second deviation and between the 6 month and the 1 year. So we'll quickly note these levels. If we are looking for kind of some key intraday levels to potentially be paying attention to. So we have $280.75. That's our 6 month second deviation. So that's there. And then looks like we're coming into support on our 1 year, which is at 274.95. So those are the two key levels we're looking at over on Tesla. Let me post that into the Discord because I imagine Bradley's interested in that. We're going to cut back to Bloomberg. Again, we'll cut in when we need to.
Payrolls increased 497,000 in June. That was more than double the median estimate in a Bloomberg survey of economists. And we check the markets all day long here on Bloomberg. The S&P 500 down 1%, down 44 points at 44,003. The Dow Jones Industrial Average down 1% or 350 points at 33,938. And the NASDAQ is down 1.1% or 147 points at 13,645. 10-year Treasury down 25 30-seconds, yield 4.03%. The yield on the 2-year 5.06%. NYMEX crude oil is down 0.5% or 39 cents at $71.40 a barrel. COMEX gold is down 0.5% or $9 at 19.1820 an ounce. The euro 1.0871 against the dollar. The yen 144.25. We're watching Meta Platforms today. It is higher, up about 0.6%. It's Instagram officially unveiling Threads, that app designed as a direct rival
You're on
to
Threads,
Twitter.
Karen. Come on.
Yeah, me, no. No. But you know what my question is? Like Twitter, like I'm going to Twitter.
Forgot my mic was muted. Sorry about that. I was going to say, yeah, I see you're short at what, $60.98, so near break even now. Yeah, any reason why your stops there are not above the deviation and VWAP? Any reason for that, or are my levels a bit off? Also, any of you looking to trade Meta today off all the Threads news? And are you looking to download Threads? I've downloaded it today because, again, Twitter has been quite annoying recently with all their API updates. So Threads might be able to combat that, and if so, could potentially come out on top, at least for some audiences. So it will be interesting to see.
For a lot of folks, it's called affordability. And for a lot of people, home ownership affordability
Or what
is
you
very
can
tough.
buy.
Sure.
I mean, you're looking at something. I mean, you know, like McKee's looking 2.3.
He's out in the Hamptons just browsing.
Million,
Yeah, I know.
You know, a starter home out in the Hamptons, and the answer is all of a sudden you wanted to spend 2.3 million.
Yeah, retesting that level now, but I'm guessing you're stopped out then if your stop was at the 11 cents. Oh, just typical risk based on the candle. NCLH at third dev. Yeah, that NCLH, same as Carnival Cruise Line. I'm not touching it. I guess it could be better for you as a continuation trader, but from a reversal standpoint, I'm not a fan of it. It's been hitting that level so many times now that I don't really want to play against it. Yeah, 22.40. I'll quickly update the levels though. But I'm not touching that at all. What, $23 and... Yeah, because as of right now, even on NCLH, it's still not hitting the third deviations, but it keeps hitting it basically every day. So not looking at NCLH anymore, at least from a reversal standpoint. Continuation could be alright. And Carnival Cruise Lines, same thing. It says it's already hit the third, well, it has already hit its third devs multiple times now. There we go. It has hit it several times, but again, the levels keep moving there. It even shows like the 6 month hasn't hit yet, even though it has. So I don't really like the look of either of those. But at least that's just down to me.
You take the domestic economy and off the end is net exports. How does that dynamic fit right now? I mean, is net exports going to dampen us down to some gloom statistic?
I'm not going to go up against Conrad on that because I haven't studied the numbers in that sense in how I put it together. But ADP does, the Atlanta Fed does include the trade figures when it makes its estimates. And the numbers that we just got were
breaking lows on Meta now.
So it does suggest that it's not going to really hurt it. But we'll find out, I guess, fairly soon, end of July. We'll get that. On the mortgage rate thing is interesting, though, because...
Also seeing Carnival crush as well. It could potentially play a long bias bounce on 1822. I'd be a bit more confident trying to catch these long bias and short bias, so could potentially look for that.
People into the new homes market, which is on fire. And I've seen ads now for a number of home builders where they're buying down your mortgage.
Right.
And so you can get a 4% mortgage on a new house, which makes it more affordable. And the thing about new houses is they add a lot to GDP because there's not only just the housing itself, but all the construction that goes with it. And every new house needs a new refrigerator and stuff like that. So the fact that we're seeing a lot of strength in housing is something that I don't want to say scares the Fed, because the Fed isn't in favor of a bad economy, but it does suggest to them that there is more work to be done.
Well, 6 minutes to the ISM PMI and JOLTS job openings.
Michael, or at least put it to the edge of the table.
It is largely coming off. There are, as you have heard on surveillance, there is a camp that says we still are going to face recession. A lot of that based on the
Biden administration is set to provide $6.88 billion a grant for New York Hudson Tunnel project. And we've also just seen the CBOE volatility index hit 1 month highs, last up 1.45 points at 1560. So again, that's going to be the VIX. Yeah, big gap on the VIX. So interesting.
We're going to be looking at all this jobs data. I'm going to be focused on the average hourly earnings year over year. Consensus is 4.2%. Again, the Fed's going to say, I need to cool this thing down, right?
Yeah, I mean, what we have seen with inflation and wages is sort of a very, very slow grind down, and you chart it, and it looks like the line is almost flat.
Well, so Brad, is that one thing you've looked into potentially testing? But then if you're using the deviations as levels, basically just stops above, because like in that case, when it's that close, when you got, when you could have risked maybe an extra 5 or 6 cents and had it above the level. Don't know how often you see it kind of bang straight off that level, but in that case, I guess it worked pretty decent.
So fortunate that the Bloomberg surveillance congestion correspondent, John Tucker, just walked into the office. Paul, this is
it the Helix?
Caroline Spivak. Amtrak power issues halt service from Philadelphia.
Oh, boy.
Disrupts New Jersey transit. I mean,
Okay, here's yesterday. I walk over to Penn Station yesterday. My choo-choo out to Western to the swamps of Jersey isn't running, so I had to hop in an Uber. It's just, it gets hot. They have problems. It gets cold. I know. I put the call in, but it was.
Remember, the signals are DC. They go to the rails, so you get heat or cold.
They're not having this conversation. We're not having this conversation in Paris. I don't understand.
Assuming they come to work.
Nation.
Yeah. Yes.
I mean, I just don't.
Well,
get
they just earmarked $6 or $7 or $8 billion. Just got approved. I saw Senator Schumer for the Gateway project. So that's like the big okay.
That's the
for
tunnel?
the big money. Yeah, that's the and you can see them working. You take the train in every day.
Well,
they're working every day.
Let's bring it back.
Oh yeah, I remember you talking about that. Yeah, I guess it's a bit annoying, especially considering it's gone near those lows.
No, the issue's the helix, but continue.
And so, as long as fast as companies and governments can get plans in place.
Well, so just going to spend a minute. I'm going to update these charts that are normally on the screen because I want to add on some of the key things. I have the VIX on there at all times. Also have on the dollar and probably the bonds. So I'm just going to try and make that so still presentable. So I'll sort that out now.
The first through the tunnel.
We call that the big dig.
Yeah.
But Paul, seriously here, I'm with you. I'm seeing construction everywhere.
Yeah, and I tell you,
everywhere.
The workers are out there. There's cranes. There's all kinds of stuff going. So they're moving some dirt out there.
Yeah, John Tucker, very quickly here, have you been medicated over the new congestion tax? Are we close?
Well, Governor Murphy promises to lawyer up, so I'm counting
Chris
on
Christie's available.
We can do that in Jersey.
John Tucker, thank you so much. Surveillance congestion correspondent here this morning. Tomorrow, seriously, folks, we've got huge moves in the market, and they affect you. Tomorrow morning at 8:30, Mike McKee will go beneath the headline data. Please stay with us worldwide on Bloomberg Radio.
Even in a time when almost nothing is easy, one thing has been effortless.
We watch sterling now shooting up.
Accessing the world's latest financial and political news.
European central banks fight to tame inflation isn't over.
Wake up with Bloomberg Daybreak Europe Edition. Available now on your podcast feed each weekday morning by 7 a.m. in London. Get the news you need to start your day in just 15 minutes. Subscribe to
I'll actually deal with that in a second because we do actually have the data coming out in about a minute and a half. So we'll just be ready to look at that then, I guess. For this, again, mainly just watching how the SPY or the Qs move. Again, this will normally be a fade release. As long as, again, we'll be watching for what the ISM PMI comes out in. But as long as those services come out above 50, should be pretty much a fade. So you'll probably get a pop in one direction and we just look to play it back to basically flat. That's what I'll be looking at again. I'm looking at it on the futures, not so much on the index because it's just a bit easy to trade. So I'll throw on the S&P up here. We'll also keep an eye on how the bonds move coming into the release. And I wouldn't mind keeping an eye on also how the dollar moves. So again, we'll watch all of these in. We've got the bonds. Again, when you're at ZN, that's the 10 years. You can also look at ZTs to look at the 2 years. So we'll look at the bonds. We got the dollar down here, the NASDAQ ETF, the S&P ETF, and then we got the S&P futures. Again, I'm looking at the futures to trade myself. That's how I'll be trading it. There we go, 10 o'clock. There you go. You should hopefully see a fade. Waiting for the numbers. Came out. Yep, came out fine. Came out above, so a fade is what I'm looking for. Dollar bounce quite strong. Is a super strong move. The bonds are basically faded. Okay, potentially now breaking a bit down on the S&P. Again, the bonds are basically faded. Dollar still near at the highs. The S&P near the lows. And again, the bonds are given back, kind of giving back most of the move. And there we are. I'm out the futures. I got them out on that spike there. got out a bit early. The main reason for this is we can see the dollar's still trying to push those highs. The bonds are basically faded, so I'm not as confident on the S&P to get a whole fade, but it was still about 3 points. We also have Fed's Logan. Fed has room to shrink balance sheet for quite some time. Yeah, good thing we got out on the S&P then. Again, we can see now it's crumbling. That's why I'm paying attention. I don't just look at the S&P. I look at the bonds and I'm looking at the dollar, because if we see strength in the dollar, the S&P is likely to fail. That's quite nice. And again, the bonds are never too strong of a move. And so if we look to fade, it's pretty quick in and out. But it's why I don't really trade them. S&P is usually the most liquid and easiest to trade. Again, I'd be watching for the dollar as it comes into that 103.294. Again, that's a level from the pre-FOMC release. We've seen that level act out quite nice. If we can continue to push up, we're starting to see a bit of a divergence now between the S&P and the dollar. Dollar's pulling back while the S&P is as well. Bonds are starting to fly up. Bonds look like they're about to get a full fade. Dollar's coming back, might even get that full fade on the dollar. You tend to actually get them on currencies anyway. We'll cut to Bloomberg because they're talking about the ISM data now.
That's coming in just a little lighter than expectations and a decrease from the prior month. Now, the prior month was also revised higher. As for ISM, this is the services index, the biggest part of the U.S. economy. Expansion there, 53.9. That's higher than the previous month, higher than expectations. Again, anything over 50 is expansion. Services, the biggest part of the economy. I'm going to go right to yields, lightening up just a little for the 2-year, 5.08%. That's still an eye popper. 10-year yield, 4.04%. As far as the equity indexes, S&P 500, 51 points lower. That's down 1.1%, 43.95 in the index. The Dow down 376 points. The NASDAQ 100, 209 points lower. That is down 1.4%. Stronger than expected ADP figures. We got that earlier today behind the latest push higher in the yields. Meantime, Andrew Hollenhorst, the chief U.S. economist at Citigroup Global Markets, he does see inflation heading in the right direction.
Yeah, so we have some positive dynamics over the next few weeks, actually, in the inflation data, where you should see used car prices coming down, shelter prices should be slowing. So there are reasons to think we're going to slow into the end of the year.
And far as some of the individual stocks on the move, say hello to Threads from Meta Platforms, Instagram. The most serious threat yet to Elon Musk's Twitter. In its first 7 hours, saw more than 10 million signups. Tesla, China's top automakers, they're pledging to maintain fair competition and avoid a price war. Tesla shares most active. They're down about just over 1%.
Basically a full fade on the bonds. Again, still waiting for a full fade on the dollar and the S&P. But again, if it was something we were still in, we would be jumping out by now because it hasn't fully faded. Again, that's why we got out. We called that on the stream. Didn't want to stay in that as soon as we saw the dollar diverge. But yeah, bonds look like a safe bet. And again, we can go back and test this. Never really pay attention to the bonds all that much in the release. I'm usually paying attention to the dollar and the S&P. But if the bonds are kind of that quick and instant of a fade, we'll do that more often.
Looking at the 2-year Treasury yield, it's actually at its highest level in 16 years on the back of that ADP data. So it's the highest it's been since June 2007, just above 5%. So if you look at that over to the equity market in the S&P 500, all 11 sectors in the index are lower, led by declines in discretionary. And then you have real estate down more than 2% as well. And then energy obviously getting pressured with U.S. crude prices down close to 1%, still trading around $71 a barrel.
Wait, think about that, June 2007. I remember that time so clearly.
It's a wild chart
the
with
great
the 2 year. year.
Great financial crisis. All right, let's check in on those markets. Big moves. We'll check in with Abigail Doolittle. She's Bloomberg Markets correspondent, joining us here in our Bloomberg Interactive Broker studio. Abigail, lots of stuff out there, lots of moving pieces. What are you looking at?
Well, there's a drop in stocks, to put it mildly. The S&P 500 down 1.2%, the Nasdaq 100 down 1.4%, the stocks, the chip stocks down closer to 2%, and all of it having to do with these yields spiking. It's hard to know which is more interesting. I think both are not so surprising, because if you follow the indicators that we all follow, the RSI and the S&P 500, and as importantly Apple, just recently coming out of overbought territory. Apple is no longer in that $3 trillion mark. I think something else that I'm really keeping an eye on is ExxonMobil. They basically pre-announced to the downside, and know that both of you know that I've been talking over the last week or two that I think that this upcoming earnings season could be a little bit funky, similar to what happened with General Mills, a little bit of a disappointment with the guide. And I think that we're going to see some downside surprises. We've had some easy cruising for a while for a lot of these companies, and I think that it's just about to get a little bit bumpy. The charts, the technicals have been suggesting that something like this could happen, and now that we have Exxon doing this, plus on the other hand, the super hot jobs market. So it's a real contrast in some ways.
Yeah, and looking at the S&P 500 trading below 4,400, and you just were talking about the technicals. What stands out to you? Because we always ask you about RSI. You were talking about how that's come off a bit of the highs that we would have seen back in June, but is it still a bit too elevated in that overbought territory?
So the S&P 500, what's interesting to me is, this is very wonky, but it's in what's called an island reversal pattern. So right at this moment, it's confirmed to go back down toward, let's call it 43.40 or so. If it should break below 43.30, and again,
And you were talking about these levels that you're watching for the S&P 500, pretty close to 43.25, which was that intraday high August 16th of last year, which a lot of times, as you know, served as resistance. But now is that really more of kind of that support potential level there?
For the S&P 500?
Right.
Let me pull up the chart quickly and see whether or not I agree with that. I don't think that that will hold, though, based on the last time that I've looked. If you see the S&P 500 go below 43.28, you're going to see a sell-off to the 50-day moving average, if not below.
Right, so it's right below that.
Yeah, that will not act as support.
Right.
I would be shocked if that acted as support. I shouldn't say definitely won't, but I would be very surprised.
All right, Abigail, thank you so much for joining us. Abigail Doolittle, Bloomberg Markets correspondent. All right, we've got a good block of time here, and we're going to need it. Danielle DiMartino Booth joins us here on our Bloomberg Interactive Brokers studio. You know her work, CEO and Chief Strategist at QI.
Dollar really flying now, considering the SPY's really just chilled out. So strong direction on the dollar. We'll see as well if we can beat the FOMC release high. Oh no, sorry, we already have. Again, massive move then on the dollar. This is where the FOMC release number came out. We broke to the high, started to fade, and now we're breaking those highs, or we have broken those highs. So interesting to see. We'll start seeing when the dollar will chill out. I imagine obviously you'll see this big move and we'll start to see a pullback, probably looking at that high then as a potential support.
Rising year-over-year continuing claimants. So the number of individuals in 0 states in terms of rising beneficiaries.
Okay.
Last September. 46 states, as of this morning's data, have rising continuing claimants. That's 94% of the population.
Wow. Okay, so what's that tell you?
And it's been gradual, by the way. This is not like from September and a light flipped on in July. It's been a very gradual move. And it tells me that even though the data is not fast moving, that seasonality is really giving a lot of trouble to a lot of these other data sets. And it just tells you that there's been a steady degradation in the U.S. economy viewed through the purest prism of people continuing to claim jobless benefits. Not initial. They're not applying. They're collecting.
What is ADP? I don't know what to do with ADP data.
You know what you do with ADP? I'll tell you what.
Okay.
With ADP, you go, look, we've had about 348,000 last 6 months NFP, non-farm payrolls.
Yep.
ADP's 363 last 6 months. Okay, fine. It's caught up.
Okay.
Moving on. I mean, some of the aberrations in the data are bizarre.
Right. Okay.
I mean, leisure and hospitality. Mining. Did we discover copper in America?
Mining.
Because that was a huge pop in mining. So, and we've seen the we've seen the Baker rigs, Hughes rig count. I can't speak this morning.
Yeah.
I've had too much coffee. We've seen rig counts come down.
Okay.
So there's no reason to think that there's a whole bunch of shale formation that's pulling people into the energy patch.
So you think the economy is weaker than some of the headline data is showing?
I think the economy is weaker. If you look on a granular basis.
Wouldn't that give the Fed some reasons to pause, if not?
I don't think the Fed wants to pause.
Okay.
I think the Fed is looking for reasons to keep going.
Okay.
I think if you pay attention to how they will not discuss the balance sheet, we're not talking about quantitative tightening. It's like Voldemort. They won't talk about it. But they can't have quantitative tightening. They can't continue to shrink the balance sheet if a discussion is even entered into about easing where rates are. They have to keep rates high to keep shrinking the balance sheet.
So we're getting all of this labor data ahead of tomorrow's important jobs report.
Yep.
And it's interesting. I'm looking at EcoGo and the terminal, and it looks like the unemployment rate is actually going to tick down from 3.7% through 3.6% based on analysts that we're polling in the terminal. You look at when it comes to non-farm payrolls, about 225,000. What is your take on what we could see tomorrow, and obviously how that could potentially relate to how U.S. stocks are moving on the back of this type of data that clearly, not even just the stock market, but looking what's happening with the 2-year?
And the 2-year really is where it is all at this point, right? I think, I can't tell you what NFP is going to do tomorrow. I had a friend of mine, Peter Scheer, he's a good friend of Bloomberg's. He made the comment, statistically speaking, what are the odds that 14 months in a row, all the economists miss the estimate? I mean, what are the odds? I mean, the BLS will tell you that 42% of the jobs created in the last 42 months are against a backdrop of the fastest bankruptcy cycle since 2009. So how do we have a birth-death adjustment that adds 42% net of all non-farm payroll jobs? 42% is not a small number over the last 12 months in the aggregate, assuming that this is all births, when you can pull up BCY Go on the terminal and see the biggest number since 2009.
So when you see the 2-year at a 16-year high, what do you think the bond market is telling us?
It's telling you the Fed's going to keep raising rates, come what may.
So we've got 90% priced in for the next meeting. They go again after that, you think? September?
I think it really becomes data dependent at that point, unless there's going to be an investigation launched at the Bureau of Labor Statistics, because they're already questioning the inflation data. That's a matter of public knowledge. So, I mean, barring that, you don't get to 46 states with rising continuing claimants without somebody starting to notice that there's a problem in the country.
So what is your overall take of this economy, that there is, in fact, more weakness than the headline data would show, but yet they're still going to raise rates?
It's the but yet. Remember, the employee retention credit, they advertise all the time.
Sure, we did that.
It just pumped $28.8 billion into the U.S. economy in the month of June alone. It's been about $20 billion a month now for about 18 months. There's a massive form of COVID fiscal stimulus that continues to make its way into this economy. You see it in international travel. But as Torsten Slog came out in his morning note this morning and said, the U.S. consumer is slowing. I think it pained him to say that. But if you look beyond the recipients of this employee retention credit, kind of the wealthiest, the highest income earners, you're seeing decided signs of slowing in consumption.
So then with this jobs report tomorrow, we have CPI on July 12th, so next week. And then we'll have the Fed meeting on July 25th and 26th. So those are the last major data points before that. Is that enough for them to decide to potentially hike?
Oh, I think it is. I really do. Again, he's focused on an inflation metric of his own design, the core CPI net of shelter. And it is a slow-moving animal. We've gone back and looked at it historically prior to the pandemic. It was usually running at about 2 to 3%. but 2% was a rarity in that isolated metric that Jay Powell has conceived out of thin air. So in that he's looking at that, I think that it's very conceivable. Where Omer Sharif is saying, look for used cars prices to come down. Look for shelter to continue falling.
Yep.
Look for that next CPI print to be very bond market friendly, unless Jay Powell's just going to look through it as you go 48 hours into blackout.
Right.
Before the next FOMC.
What is one of the many reasons we like speaking to you is you rip out some data points that, quite frankly, I've never heard of. What are some of the data points that you and your team are kind of looking at here to get a sense that maybe aren't on EcoGo?
So we actually follow weekly data from Lightcast. They started tracking the data as of January 2020 to get a benchmark for which types of job openings there are in the nation.
Okay.
So jobs with minimal education required, they needed a new scale in order to track how many job openings there were for leisure, hospitality, busboys, you name it.
Yep.
That's recently, through the week of June 24th, come down to 0. So there are effectively no job openings using a benchmark of January of 2020. I follow Truflation very closely, TRUflation. We actually were able to get their full data set back to 2012. We ran a correlation analysis with the headline CPI last Friday, 97% since 2012, the correlation. Whereas Truflation today, 2.2%.
Okay.
It's 30 million real-time prices. It's a daily inflation print, but a 97% correlation since 2012 with headline CPI tells you exactly where inflation is headed.
So inflation's headed lower.
Much lower.
And isn't that good news for Jay Powell? And that's what he wants to see, right?
It's not good news for that Jay Powell. That Jay Powell wants to continue shrinking that balance sheet.
Oh, man.
And he wants a reason to continue shrinking that balance sheet. So he's going to focus on job openings remaining high, even though work out of the Dallas Fed shows that 90% of those job openings are written for the specific purpose of poaching your closest competitors' employees so you don't have to spend the money training them. The other 10% actually reflect organic demand in the economy for new job openings. That's being reflected in Indeed.com as well. You're seeing Indeed.com job postings have come down tremendously over the last 12 months. That's another big one that we follow. And again, it's a weekly data set, and they're speaking to thousands and thousands of companies across the country. That's what you want. You want people who are speaking to people on the ground.
And so even though we see the Fed's preferred gauge, PCE, moving in the right direction, to you, that's still not enough when you're looking at what's happening with the strength on the labor side.
And I'm going to quote Powell here, until the job is done.
Yep.
Until we get to 2%.
And 2%, what is the 2% number? That is the core X...
He's looking for core PCE to be 2%. That is typically the gauge that you're talking about internally.
Okay. All right. And we're not there yet.
Oh.
No. We got some room to go.
Nowhere near.
Excluding food and energy.
But he's going to keep shrinking.
They also like to exclude housing.
We get data out today at just after 4 o'clock. You're going to see a big chunk of quantitative tightening when that data hits late after the bell today.
All right. Danielle DiMartino Booth, thank you so much for joining us here. Danielle DiMartino Booth, she is the CEO, and she is the chief strategist at QI Research. She's also did a stint at the Dallas Federal Reserve, so you know about the Dallas Federal Reserve and how the central bankers think across the board. So we always appreciate getting some of Danielle's thoughts here. And again, looking at the market, S&P off 1.2%, NASDAQ off 1.4%. But we're going to bring you to the yield market. 2-year Treasury of 12 basis points, I'm going to round up to 5.07% on your 2-year. It's not too bad to park your money for a couple of years.
Highest level since June 2007.
Yeah, that gets your attention. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, we're keeping an eye on Eli Lilly shares today after it became the world's biggest healthcare company by market value yesterday, surging ahead of health insurance giant United Health Group. Bloomberg's Charlie Pellet reports.
Steve Lilly's climb has been fueled by its pipeline of drugs to treat obesity, along with an experimental treatment for Alzheimer's disease. The rally has made Lilly the top-performing stock in the S&P 500 Pharmaceuticals Index so far this year, and marks the first time the drug maker has closed above United Health in market value in more than a decade. Steve?
Thanks, Charlie. Shares of Eli Lilly currently down less than 0.25%. Meta Platforms stock opened higher, then quickly turned red, but is now up again as the company rolls out its new Instagram app Threads. CEO Mark Zuckerberg took a jab at rival Elon Musk on the Twitter owner's home turf. Zuckerberg tweeted a photo of 2 identical Spider-Men facing off. Musk replied by calling Instagram fake. The rewards for brand loyalty seem to be a little less rewarding these days. Some companies are rolling back reward programs. Experts say the costs of maintaining those programs and inflation are among the factors. For example, Dunkin' no longer gives customers a free drink on their birthday. And if you're a fan of Sephora, well, last month they started requiring a $25 minimum purchase for online shopping in order to claim a free gift. And Starbucks has done quite a few changes with their birthdays. First, it was 30 days eligibility, then 1 week. Now just 1 day. And those are the company stories we're filing this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets right after this.
Can't catch us live? Your favorite Bloomberg radio shows, including Bloomberg Surveillance, Wall Street Week, and Bloomberg Sound On, are also available as podcasts. Listen today on Apple, Spotify, and anywhere else you get your podcasts.
In a changing world, Workday helps your finance team continuously plan and adapt to change.
Okay, guys. Anything you lot are looking at coming into here? Could have a quick look at Meta. Nothing's really been too keen on levels. Again, the only trade we got was on the news release of ISM and JOLTS. A quick fade on the indexes, but that's about it. We're seeing basically Meta surprisingly actually kind of stay flat from yesterday's close. Surprising to see, but we are seeing it. So potentially could see a trend day if we can kind of break outside. What I'd be watching for is either a break of a low or a break of a high, and see if we can see something like that. But I guess let me know if there's any stocks you're looking at, and we'll run through those. Otherwise, again, we're kind of just watching. Potentially may look to open some swings, but I'm not really looking at any day trades as of right now.
The economy keeps humming along here in the United States. The service sector expanding in June at the fastest pace in 4 months. And of course, remember, services, that is the biggest part of the U.S. economy. And then you have the swaps contracts almost fully pricing in right now. Quarter-point Fed rate increase by their July 26 meeting. Some likelihood of an additional hike by year-end also being priced in. Then you have the JOLTS survey. This is job openings coming in ever so slightly below expectations. Still solid, though. Treasury yields, they saw a soaring.
Again, JOLTS came in at 9.8 million. Also, Fed Logan has said the Fed has room to shrink balance sheet for quite some time.
Mobile falling after forecasting a $4 billion hit to earnings. And then, of course, you have Meta Platforms rising after Instagram officially launching their app to rival Twitter. S&P 500, 56 points lower. That's down 1.2%, 4390 on the index. The Dow Jones Industrial Average down 445 points. The NASDAQ 100, 213 points lower. That's down 1.4%. Two-year yield, 5.06%. The 10-year, 4.05%. We check the markets for you all day long, right here on Bloomberg Radio. Is Paul already, what is it, threading?
I'm threading. Darn right I am.
Good Lord.
Are you
me? I'm cutting edge.
The last place I should be is on social media. For any
I think it would be wonderful.
Any number of reasons.
We should start a campaign to get you on social media.
No.
Go social, Jen.
I just don't fit the criteria.
I would follow you.
That's what I'm afraid of.
Great. Now we get it. Thank you, JT. We appreciate it. And before we get to our next guest, Michael Green, Portfolio Manager and Chief Strategist at Simplify Asset Management, just looking at the S&P 500, Paul, still all 11 sectors in the index lower, and we were just talking about these huge moves we've seen in the bond market, especially with the two-year Treasury yield. Michael, thank you for joining us. Before we get more into what you're going to talk about as far as what you like about sectors in the S&P 500, I have to get your take.
Well, so it's quite weird. We're seeing the SPY or the S&P hold the lows and kind of just consolidate, whilst we're still seeing the dollar continue to fly to the upside. Again, don't forget, we came out on this release at 103.142 and we're already up to 103.483. So the dollar is really strong off this release. Again, the bonds have already faded. They're basically back to break even. And the SPY kind of hugging near the lows, getting a small bounce now. But overall, the S&P still chilling relatively near to those lows.
themselves are actually now the key risk. This is exactly what we saw with the banking system earlier in the year. I think it's working its way through the corporate sector where we're seeing a dramatic rise in bankruptcies. The odd thing for me is simply that it's not reflected in spreads. It doesn't seem to be reflected in any way in the Federal Reserve's calculations. And candidly, when we look at the jobs data today, certainly coming from the ADP, I have to confess that I'm caught off sides in terms of that strength. I cannot reconcile the data. If I look at the numbers for 2023 on a non-seasonally adjusted basis and compare them to the data from 2022, they're lower in every category. So oddly, we have this seasonal adjustment factor that again is raising its head and just making me really question whether the data that we're receiving is accurate.
So I guess let's look at it, the economy from a different way. Earnings, corporate earnings. I'm looking at the the earnings for the S&P 500 consensus of analysts, about $222 per share for this year. How much risk, if any, do you see in that earnings number for corporate America?
Well, I think that there's a remarkable disconnect between the expectations data and the actual.
Also, let me know who you think is going to come out the strongest in the earnings season. You think JPM, Wells Fargo, or Goldman? I think actually Goldman's not Friday. Friday, you got JP Morgan, you've got Wells Fargo, you've got State Street, and Citi. They're the four that are coming out Friday. What ones do you think are going to perform best? Obviously, we know JP Morgan's going to make the most, but what ones do you think are going to surprise the most?
With either unemployment or layoffs, and in many ways, again, it just feels like the data is being created to match a narrative of rising prices or the reality of rising prices in stock markets versus what we're actually seeing empirically in the economy.
Michael, the S&P 500 is trading around its lowest level in about a week. Something I was curious about when we're looking at some of this stronger than expected labor data, is this potentially a reason for certain stock investors to sell after what was a very strong first half?
Well, I think that there is very much a focus correctly on what the Fed is going to do. And so we're clearly seeing, as you led into the discussion here, indications that interest rates are moving higher, that Lori Logan came out today and said she expects additional interest rates going forward. I think broadly speaking that is really what's powering the market as of this immediate sell-off as compared to taking gains or anything else. We've seen a fairly significant amount of disconnect between the S&P 500, which is obviously market cap weighted and dominated by the large market cap names, and what we've seen in, say, the Russell 2000, which is not up nearly as much on a year-to-date basis, and in fact, the equal-weighted Russell 2000 is barely up for the year. So this has been an environment in which the vast majority of stocks have been relatively weak, even as a few mega cap names, Apple, Microsoft, Nvidia, et cetera, have been very strong. In my view, that would represent mostly a flow story, effectively money going into the AI and technology space, driving performance as compared to any indication of real economics at play.
Mike, I'm sensing a distinct tone of cautiousness in your view of the markets and the economy. How are you allocating your portfolio these days? Stocks, bonds, what sectors, that type of thing?
Yeah, no, as I indicated, I absolutely have been caught in the wrong positioning on this last move. I genuinely look at the 2-year bond at 5+ right now and say I can't believe that we're being given this opportunity in an environment in which it seems very clear that at least the economy has slowed dramatically. Whether it continues to slow is really the question. And I see few opportunities for continued growth and expansion. Today's ADP is obviously a wrinkle in that, but again, I just think the data that we received from ADP today was wrong. Can't fully explain it, but that's what it appears to be, where the non-seasonally adjusted data is showing a significant divergence from the seasonally adjusted data. That's true for the claims data, that's true for the unemployment data, that's true for the ADP data.
Something that struck me just looking at the industries within the S&P 500, more of those cyclically related corners of the market are leading declines when you're looking at energy, also materials, technology down a little bit under 1%, also the NASDAQ 100 down more than 1%, but when you think about the correlation between bonds and what's happening when it comes to technology stocks in particular or growth shares, would you expect them to be more pressured given what we're seeing in the bond market?
So I'm not a huge believer in this idea that growth stocks or large cap growth stocks in particular have a quote unquote high duration. In other words, a high degree of sensitivity to interest rates. I think we've obviously seen that, with the strength in the Apples and the Microsofts on a year-to-date basis, where despite the fact that we have much higher interest rates, they continue to push higher. If anything, I think that there's an explanation that has much more to do with kind of portfolio allocation dynamics than any sort of fundamentals around interest rates and valuation. Again, I would just lean towards the direction that what we're worried about at this point is the Fed continuing to be overly aggressive with the hikes that are already in the system, not in any way reflected in the underlying data that we're receiving yet. As that moves forward, if the Fed continues to hike or pauses in its response, that creates conditions under which a slowdown could actually end up being much more severe than is currently being priced in or versus expectation. And that unfortunately continues to be my rising base case, that the Fed is simply behind the curve in the opposite direction. Again, the ISM prices paid data would suggest that the inflation story is well behind us. We see this in Europe, where the CPI, the producer price index, has turned negative. We're just seeing data that suggests that the inflation story is no longer the operative dynamic. Doesn't necessarily mean that that's right, though.
All right, so real quick there, Mike, what do you think we're going to hear from our Federal Reserve at the next meeting and maybe even the meeting after that?
Well, I think it's hard to argue with the market, right? So when the market suggests that they are more than 85% probability of going, and historically it's been about 70%, it's been very rare for the Fed not to take advantage of that. I would expect that they'll ultimately hike and that they'll indicate, as the data suggests certainly today, that the economy continues to represent strength. I don't really think that they're focused on the inflation story as much as they are focused on, or the direction of inflation story, which is clearly downwards, as much as they are focused on this idea of we've got to get back to 2%.
Right.
That is going to be the real question is, do they continue to hike until we get to 2%, which would suggest that they're going to be way behind the curve in the opposite direction.
All right, Michael Green, Portfolio Manager and Chief Strategist at Simplify Asset Management. Thank you so much for joining us and getting your purview here on how you're positioning in this stock market as well. And Paul, just looking again at these groups in the S&P 500, all 11 sectors still lower in the S&P 500 right now, led by declines in energy as well as materials. We talked about oil prices still trading a little above $70 a barrel, but still down about 1% right now. And then also consumer staples is just down about 0.8% here. Right.
So, cyclical names here on higher rates. Right now, let's head down to Washington, D.C. World and National News with
Paul, Yevgeny Prigozhin is back in Russia. That's what the president of Belarus, Alexander Lukashenko, is saying nearly 2 weeks after the Wagner Group leader agreed to turn his mercenaries away from their march on Moscow to go to Belarus and avoid charges. Lukashenko says Prigozhin has been to Vladimir Putin's hometown of St. Petersburg, may have gone to Moscow as well. The Kremlin says it's not tracking Prigozhin's movements and doesn't want to. In Ukraine today, Russia fired cruise missiles on the western city of Lviv, killing at least 4 people in an apartment building. Ukrainian President Volodymyr Zelensky is promising a strong response. He is pushing for even more support from allies.
F-16s or any other equipment that we do need will give us an opportunity to move faster, he said, to save more lives, to stand our ground for a longer time.
President Zelensky spoke with ABC's Martha Raddatz in Kiev before the attack. Today, Zelensky is in Bulgaria for a one-day visit, and he plans to meet with Turkish President Recep Tayyip Erdogan tomorrow ahead of next week's NATO Leaders Summit in Lithuania. Treasury Secretary Janet Yellen is in China for the start of her 4-day visit. She's meeting tomorrow with Premier Li Qiang, along with her former counterpart Liu He. Jeanette Lowe, Director of Policy Research at Strategas Security, says Yellen will be looking to reset the dialogue.
She's trying to kind of tone down the rhetoric that we have seen over the past couple of months
we've had some issues with, planes coming close to each other, ships coming close to each other in the South China Sea.
Virginia Lowe at Strategas spoke on Bloomberg Surveillance. Anti-government protests in Israel are turning more heated, this time over the firing of Tel Aviv's police chief. Thousands blocked highways and set bonfires before police and water cannons broke them up. More than a dozen protesters were taken to the hospital. It's a step up from the mostly peaceful rallies back in the spring over plans to weaken Israel's judiciary. Global news powered by more than 2,700 journalists and analysts in over 120 countries.
We're recording this Progressive commercial on a real boat to let people know that when you bundle your home, boat, and other vehicles... What was that, Flo? Progressive saves you money, Jamie.
Why are we doing this on a boat?
We were going for authenticity.
We're going to the city?
Authenticity.
You mean Atlantic City? But we're not in the Atlantic. Are we?
Bundle your home and other vehicles with Progressive. Progressive Casualty Insurance Company, affiliates, and other insurers. Discount not available in all states or situations.
It's time for the music that's trending on TuneIn.
Dance With You by Brett Young. Now playing on the Big 6-1.
Favorite sound today.
Follow it tight. If you love sports, then you've got to upgrade to TuneIn Premium. It's your ticket to top play-by-play from the biggest leagues. We're talking NHL, English Premier League, MLB, and the biggest college sports.
High and deep right center field, and that baby is gone.
Plus, commercial-free ESPN radio for hot takes between games. Stay competitive on your fandom with TuneIn Premium. Upgrade now to get in the game.
Today's news can feel like uncharted waters. But more often than you'd think, we're not the first generation to confront what we're dealing with today.
We're just the first generation to make a podcast about it.
I'm Rachel Maddow.
I'm Isaac Davy Aronson. Each week, we'll bring you a story from history
that helps with something in the headlines today.
Rachel Maddow presents Deja News with Isaac Davy Aronson, an MSNBC podcast. Listen now on TuneIn.
To protect her home and family in a disaster, Karen was willing to wade through water, mud, and insurance paperwork.
Yeah, I can do this.
You go, Karen! By simply understanding and updating what her insurance covers and doesn't cover now, she'll be better prepared no matter when disaster strikes. Learn other simple ways to protect your home and family before a natural disaster at ready.gov. That's ready.gov. A message from FEMA and the Ad Council.
There's a lot to listen to on TuneIn.
Music. At 17 years old, working a part-time job.
Reaching over the railing, he caught it! But if you want to discover some new favorites, follow us on Instagram, Twitter, and Facebook at TuneIn for all new recommendations. Who knows? You may just find your new favorite radio station. Follow us now and hear all the audio you love right on TuneIn.
Follow us.
Follow us.
With the pennant race heating up, you won't want to miss a single moment of the action. From now until the World Series, TuneIn has you covered with play-by-play coverage of every game.
And that one's hit well deep into left field.
So what are you waiting for? Don't sit on the sidelines. Get in the game with TuneIn's live MLB coverage.
To the track, to the wall. Oh, it's gone! Game-winning home run.
All you have to do is search for MLB or tell your device to play your favorite team on TuneIn, and you'll be on your way to the ballpark.
A wildfire. So take wildfire prevention seriously and let's save the world one day at a time. Juntos con Smokey Bear, podemos hacerlo. Go to smokeybear.com to learn more about wildfire prevention.
Brought to you by the U.S. Forest Service, your state forester, and the Ad Council.
Whether you're an in-house counsel or in private practice, Bloomberg Law gives you the edge with the latest in AI-powered legal analytics, business insights, and workflow tools. With guidance from our experts, you'll grasp the latest trends in the legal industry, helping you achieve better results for the practice of law, the business of law, the future of law. The difference is Bloomberg Law. Learn more at BloombergLaw.com.
Bridgebank helps breakthrough ideas actually break through and remains dedicated to providing financial solutions to the risk takers, the game changers, and the disruptors, those committed to making the world a better place. Bridgebank has been providing financial solutions to technology and innovation companies from inception to IPO and beyond for over 2 decades through its national network of banking.
Alright guys, I'm going to end the stream here anyway because I've got a few things to do. That's why I haven't really been talking too much. Does look though like Meta could potentially be breaking those highs. If so, then we could hopefully see a bit more of a trend and try and break that $300 mark. Again, I think we hit it pre-market. Let me put it on here, then I can actually confirm. Yeah, we did hit it pre-market, and that's where the sell-off started. So if we get that retest, we should be able to break and hopefully see a bit of continuation. Again, dollar still super strong since that release. Again, it came out at 10. We were all the way down here. We have pushed all the way up to 103.572 at the high. So big move on that. We've also seen the SPY. Again, SPY came out here, haven't had a complete fade on there. Still relatively actually continuing down. However, Qs is basically the opposite. Qs has actually faded. We can see they are now trading at a divergence. We had to trade back to the VWAP, which is now done. So again, we got the fade on there. That's going to be quite hard to hold through, at least from a futures perspective. And again, that's why we were focusing more on trading the S&P, but relatively quickly we get in and out. But like we said before, we will actually be looking trading the bonds. So again, the ZN, for example, so the 2-year bond, faded relatively quickly. You got that in a few minutes. And again, even just the original move would have been a lot more safe and kind of easy to trade. Whereas on the S&P, we had to jump out relatively quick. Because again, it was trading at a big divergence to the dollar. Again, they always trade opposite. So I don't mean a divergence like that. When they start trading in the same direction, it's normally counted a bit more of the divergence. Especially when it's on news, which should be good for one, bad for the other. So those are the key things. Just to go over some potentially, I guess, last stocks. We had MU coming into its first deviation resistance. Again, potentially could be looking at long here. I'm never as keen though when you gap below the level. Sometimes you can buy them into the open, knowing that you'll most likely get a pop above it. But if we kind of gap below it, I'm not a massive fan of swinging them. So again, probably be a bit more patient. We have the next level, I think, at 58. Yeah, 58.10. So we'll probably be looking to take a long bias coming into there. We also had actually an alert come out on, trying to see if I can see it. I'm just looking around. Can't see what the alert was. Actually, I'll be able to find it on here. We had, let me go to triggered. Oh, we had ACHR, which I think is actually a small cap, not a massive large cap by any means. Oh no, just continuing that downward move that we expected. We did actually have this short as a swing, I think around that kind of 450 average, so that would have gone into the positive now. And again, I've missed a 5, but 5 would have been a great entry. Again, that was a high pre-market, and then also coming into the open to retest it. But again, this is one of those nice stocks because it's a small cap, but easy to borrow and does have options as well. So we can define that risk, get some good opportunity on that. And as well, the spreads are tight, 1 cent, so I can deal with something like that. But I think that's kind of the main wrap up for today. Again, tomorrow, I think tomorrow and Monday will both be in shorter streams because again, we're having some work done at the house for those 2 days. So hopefully by Tuesday, we should be fully back to normal. But I hope you enjoyed the stream. If you did, why not drop a like and subscribe. And thanks for the support. See you in the next one. And that's it.